Have you ever poured absolutely everything into launching what you thought was a brilliant new product, only to see it just struggle, bumping up against, I don't know, this kind of invisible wall of competitors?
Or maybe the other way around.
Yeah, or maybe you've spotted a market that looks really promising, you're all set to dive in, but then you just find yourself hitting these brick walls, everywhere you turn, just can't seem to get a solid foothold.
Right.
How do you actually cut through all that noise, all the sort of apparent chaos, and really get what the landscape you're operating in is truly like?
That's the million-dollar question, isn't it?
It really is. And that's precisely what we're going to try and unravel today. We're kicking off a foundational multi-part deep dive right into the bedrock of modern business strategy. We're starting with Michael E. Porter's, well, frankly, seminal work, Competitive Strategy.
And it's so important to stress, this isn't just dry theory stuck in academia.
No, absolutely not. It's a remarkably powerful, very practical lens. It can honestly change how you view competitive dynamics, how you analyze industries, and maybe most importantly, how you navigate them successfully.
It gives you a framework, a way to organize your thinking.
Exactly. So our mission today is really laser focused. We're diving headfirst into Porter's iconic five forces framework,
The big five.
the Big Five. And by the time we're done with this deep dive, you'll have, I think, a genuine shortcut to being really well informed about the fundamental elements that govern the structure and, well, ultimately, the profitability of pretty much any industry.
Right. It's about understanding the underlying economics.
Yes, and that kind of analytical rigor, it's just essential for seeing clearly how companies find a profitable position, how they build it, how they hold on to it, and how they develop these robust, lasting strategies that, can actually stand the test of time.
It's about sustainability.
Porter's core idea here, and really the guiding principle for this whole framework, is that the goal of competitive strategy is ultimately to find a position within an industry where a company can best defend itself against these forces. These forces are relentless.
Or, even better, actually influence them in its favor.
Right. Turn the tables a bit. But to do that, we can't just scratch the surface. We really need to delve deep, analyze the underlying sources of each force.
Yeah, you have to get granular. Porter himself really emphasized this. Understanding those sources clarifies your own strengths and weaknesses. It kind of animates your strategic changes.
Animates, I like that.
Yeah, and it helps you spot those significant opportunity or maybe threats that you might otherwise just completely miss.
Okay, so let's peel back those layers then. Let's get into it. Okay, so let's unpack this. Michael Porter, he didn't just sort of tweak existing ideas, did he? He introduced a framework that genuinely revolutionized how we think about competition.
He really did. It was groundbreaking at the time. And honestly, it's still incredibly relevant.
So he identified these five fundamental forces. And it's their combined strength, right, that determines the intensity of competition and, critically, the long-term profitability of an industry.
Exactly. Think of it like, I don't know, the structural pillars of an industry's potential profitability.
Like a diagnostic tool, almost, for any business environment.
Yeah, that's a good way to put it. It reveals the inherent profit potential. And what's truly fascinating here is how these forces don't just exist in isolation. Their collective strength, their interplay, that's what shapes the entire industry structure. Porter famously noted the intensity of these forces can range dramatically. They can be, intense in industries like tires, paper, steel sectors, where firms often earn pretty subpar returns, really struggling.
Yeah, tough businesses.
Very tough. But conversely, the forces can be relatively mild in sectors like, say, oil field equipment or cosmetics, where high returns are actually quite common. Why? Because the structural forces are just more favorable. So this framework, it really provides an almost unfailing guide to whether a strategy can actually produce worthwhile profits. It forces us to understand that underlying economic architecture of an industry.
Right, instead of just getting caught up in the day-to-day rivalries, who's launching what this week.
Exactly. It's moving beyond the surface battles.
That's a crucial distinction, I think. It moves us beyond just observing who our direct rivals are to this much broader, more structural, almost like you said, architectural view of competition. So the core question we're tackling today is, how do these five forces fundamentally drive industry competition and profitability? Let's break them down one by one. Let's see what insights they hold for you.
All right, we've kind of sketched out the big picture. Let's dig into the first of Porter's big five forces. The threat posed by new entrants.
So imagine your business is doing well, you've built something solid, maybe a good customer base, but then, the ground starts shaking a bit. A wave of new companies tries to muscle in on your territory. How real is that threat? And what makes it so hard or sometimes surprisingly easy for them to actually get a foothold?
Yeah, that's a critical question for any incumbent company, isn't it? What makes it hard for these new guys to jump into your market? The threat of new entrants basically refers to how easily new competitors can enter an industry.
Okay.
Now, if the entry barriers are low, new entrants can just flood a market pretty quickly. That increases overall capacity. It tends to drive down prices.
And eats into everyone's profits?
Exactly. It erodes profitability for the existing firms. But conversely, high barriers act like a protective moat around the companies already there.
Mm-hmm.
And that allows them to maintain higher margins, a more stable, competitive environment. So understanding these barriers is vital, whether you're inside the industry trying to defend or outside looking to get in.
Makes sense. So what are these barriers? What do they look like?
Well, let's delve into some of the big ones. First up, you've got economies of scale.
Ah, the classic. Bigger is cheaper, basically.
Sort of, yeah. It's not just about producing more, it's about the cost advantages that existing firms get because of their large volume. Think about fixed costs, stuff like factories, R&D labs, big marketing campaigns.
Right, things you have to pay for regardless of how much you sell.
Precisely. So if your total cost is, variable cost per unit times units produced, plus that big chunk of fixed cost, well, a higher volume of units produce spreads that fixed cost over way more units.
So the average cost per unit drops.
Dramatically, in some cases.
Yeah.
And this means new entrants, who are usually starting smaller, they immediately face a significant cost disadvantage. They just can't compete on price until they somehow achieve a similar scale.
Which is a massive hurdle.
Huge. And for the companies already there, this isn't just a static defense, right? It's a call to constantly push for more efficiency, innovate in production, in the supply chain, to keep widening that cost gap, make the wall higher.
Keep raising the bar. Exactly. And for someone wanting to enter, it forces a tough choice.
Yeah.
Find a niche where scale doesn't matter as much, or come in with something truly disruptive, a new technology, a totally different business model that changes the cost structure itself.
So you don't try to play their game, you change the game.
That's often the only way.
So a big company isn't just big, it's inherently more efficient per unit because of its size. That's a powerful moat. But I'm curious, does scale always protect you? What happens when some nimble, smaller player comes along with a totally different model or tech? Can that scale sometimes become like a liability? Make you too slow?
That's a fantastic point, and it's a critical challenge today. Scale offers huge protection, but yeah, it can create inertia. A startup might not compete on unit cost, but maybe they innovate on speed or personalization or serving a niche the big guy is too slow or too broad to address well.
Okay.
So these forces aren't static. Things change. But assuming a similar playing field, yeah, scale's a massive advantage.
Got it. What else builds these walls?
Okay, building on that, another powerful, almost invisible barrier comes from network effects.
Ah, yes. The more people use it, the better it gets for everyone.
Exactly. The value of the product or service actually increases as more people use it.
Yeah.
Think about early social media, online marketplaces, operating systems. More users means more value for each user, increases virtuous cycles.
Self-reinforcing.
Totally. Amazon's AWS platform is a great example. It benefits from indirect network effects. More users attract more developers building tools for AWS.
Which makes AWS even more useful.
Right. And more integrated into the tech ecosystem. It becomes the default choice. That creates this sticky, self-reinforcing advantage that's incredibly hard for a newcomer to replicate. It's not just about market share, it's about the whole ecosystem growing around it.
Like Amazon, Google, Facebook. They got that critical scale early, often by chasing things others ignored.
Exactly. They built those network effects before everyone else quite realized their power.
That's a perfect illustration. It's that self-reinforcing cycle. The more popular you get, the more indispensable you become.
Yeah.
It's not just market share, it's this value share that grows with every new participant.
Absolutely. Now, beyond the purely quantitative stuff, there's also brand identity and loyalty.
The power of the brand.
Hugely important. Established brands have built-in customer recognition, deep trust, sometimes even an emotional connection nurtured over years, maybe decades.
Right.
That makes it significantly harder and way more expensive for newcomers to lure customers away from those entrenched preferences.
Yeah.
Think about Patagonia. Their innovation with like vivid colors and new materials like capilene and Sinkilla that allowed them to stay ahead when competitors were just putting out, rip-offs.
They built this loyal following that valued their distinctiveness, their ethos.
Exactly. Not just quality, but what the brand stood for. Similarly, Starbucks created a whole new market space, partly through having this distinctive, memorable identity. That brand strength isn't just a marketing asset, it's a formidable entry barrier. It takes immense investment and time for any new player to even begin to match that.
You can't just buy that overnight.
No way. Then there's a very tangible barrier: capital requirements.
Okay, this is just about needing deep pockets.
Pretty much. The need to invest huge financial resources just to compete effectively. Think about Amazon's fulfillment network again, building the cable pipe of stuff into the world's wealthiest households.
Yeah, that's billions, right? Warehouses, robots, shipping.
Massive capital outlay. And it's not just the initial build-out. It's the ongoing maintenance, the tech upgrades, the expansion. It demands continuous capital. Even in supposedly digital industries, the back-end infrastructure, the data centers, the specialized talent that often represents enormous capital requirements too.
That's a big one. You can have a brilliant idea, but if you can't afford to build the infrastructure or the distribution or the marketing muscle to deliver it at scale, well, you're kind of dead in the water before you even start.
Yep. It separates the dreamers from the serious contenders.
Okay, what else?
Finally, there are proprietary product differences and specialized knowledge.
Things like patents or secret sauce.
Exactly. Existing firms might have unique products, patented technologies, specialized knowledge that newcomers just can't easily replicate or access. Patagonia, again, shifting to Capilane and Sinkilla, created advantages that other companies had to scramble to keep up with.
Right.
Or think about pharma companies and their patented drugs. That patent period grants significant proprietary advantage, letting them charge premium prices based on unique formulations, massive R&D investment, regulatory hurdles.
It's not just the patent itself, it's a whole ecosystem around it.
Right. The knowledge, the trade secrets, the investment that makes it unique and hard to copy. It could also be things like preferential access to raw materials, maybe favorable geography, government licenses even, that limit entry.
Okay, let's make this really concrete. Let's look at Blockbuster. We've mentioned them. For years, they were the dominant player in video rentals. Huge footprint, massive brand recognition. They seemed totally insurmountable, didn't they?
Oh, absolutely. They were the definition of an entrenched incumbent.
But something fundamental changed. They got caught completely off guard by a new entrant that, well, at first glance, seemed almost irrelevant.
Indeed. And the story of Blockbuster's demise really highlights Netflix's smart strategy. Netflix's initial DVD by mail business, it created what's called power over Blockbuster. Initially, yeah, it seemed like a niche service. Different segment, maybe.
Fewer stores' mail order seemed clunky compared to walking into a store.
Right, but it was chipping away by offering convenience, no late fees, wider selection. Crucially, though, there was this long-term time fuse attached to the DVD business, meaning Netflix clearly recognized that physical DVDs would eventually be supplanted by digital streaming. The timing wasn't certain, maybe, but Moore's Law, faster internet bandwidth, it guaranteed this outcome.
They saw the future coming.
They saw the digital future rising over the horizon. And importantly, they acted on it. They pivoted, invested heavily in streaming, even when it probably hurt their profitable DVD business in the short term.
They avoided being just warehouse flicks.
Exactly. They transformed from a physical distribution company into a tech and content company. And this shows how a new entrant, even starting with something like mail distribution, can fundamentally shift the landscape by recognizing and acting on the threat of a substitute streaming in this case.
And that substitute became the new entry point.
Precisely. It created new barriers, new rules for the game. Blockbuster, tragically, defined itself too narrowly. We rent physical things from stores. Netflix understood. We deliver entertainment. Big difference.
Huge difference.
Yeah.
So what does this all mean for your business, for the listener? If you're looking to enter a market, you've got to be brutally honest about how high these walls are.
Can you really overcome established scale economies?
Yeah.
Build a brand from scratch against giants? Secure that massive capital?
And if not, you probably need a fundamentally different approach, right? A different angle.
Definitely. And if you're already in a market, you need to be constantly reinforcing these barriers or finding new ways to compete, because those time fuses for new tech or new models, they can burn way faster than you think.
Yeah, what looks like a minor alternative today could absolutely be tomorrow's dominant player. You can't get complacent. Okay, now let's flip the coin. We've talked about potential invaders. Let's turn to a force that's always there, often underestimated, the power of your own customer.
buyer power.
Can they really dictate terms? Can they squeeze your prices, force you to change your product, your service? I mean, most businesses want to think they're in charge, don't they? But the reality is often way more complex. Buyer power is relentless.
It really is.
Yeah.
The bargaining power of buyers refers to their ability to push prices down, demand higher quality, maybe more services, or just play competitors off against each other to get a better deal.
So they can shop around aggressively.
Exactly. And if buyers collectively have strong power, they can significantly erode the profitability of the entire industry. Firms get forced to concede to their demands, margins get squeezed across the board, and it becomes really hard to sustain high returns.
Okay, so what gives buyers this power? What makes them strong?
Several things. Firstly, concentrated buyers. If there are only a few buyers, but lots of sellers trying to sell to them, each individual buyer holds significant sway.
Right, like a small supplier selling to a giant car manufacturer.
Perfect example. You might have little choice but to accept their terms, their quality demands, their price points, because losing that one big buyer could be catastrophic for you.
Okay, what else?
Secondly, if what you're selling is an undifferentiated product, basically a commodity.
If your widget is just like everyone else's widget.
Precisely. Then buyers can easily switch to a competitor. Price becomes the main, maybe the only, decision factor. There's no unique value proposition keeping them tied to you.
Which leads to brutal price competition.
Absolutely. Decimates profits across the industry.
So if your product is just like everyone else's, your customers essentially have all the leverage. You're just another option on the shelf. And that's not just inconvenient, it's a direct hit to your profitability.
Exactly right. And that ties directly into the third factor, low switching costs.
How easy it is for them to jump ship.
Yeah. How easy and inexpensive is it for a buyer to switch from one supplier to another? If it costs them virtually nothing. No setup fees, no retraining, no data migration headaches, no disruption. They can switch instantly for a better deal.
Like changing your brand of printer paper versus changing your company's entire ERP software system.
Perfect contrast. The ERP switch involves enormous switching costs, data migration, training, operational disruption. That gives the ERP vendor way more power than the paper supplier. Conversely, if switching costs are high, buyers are more locked in, and your position is stronger.
Okay, makes sense. Any others?
One more big one. The buyer's threat of backward integration.
Meaning they could start doing it themselves.
Exactly. If buyers can credibly threaten to produce the product or service themselves, that car manufacturer might threaten to start making its own engine parts or seats if its suppliers push prices too high or slip on quality.
Okay.
That threat forces suppliers to be more accommodating. It also puts a kind of ceiling on what suppliers can charge, because the buyer always has that nuclear option of doing it themselves. It might cost a lot up front, but it gives them long-term control.
Okay, let's unpack this with a real-world scenario that just fundamentally changed everything. Think about Walmart, how they completely rewrote the rules of retail. Sam Walton had this very clear, almost revolutionary idea about what customers wanted, right?
Oh, absolutely. He built an empire around it, and in doing so, fundamentally shifted the power dynamic towards the buyer.
How so?
Well, Sam Walton's initial strategy for Walmart was disarmingly simple. When customers thought of Walmart, they should think low prices and satisfaction guaranteed, period.
That was it.
That was the core. They made real hot prices, sometimes selling toothpaste for like 16 cents a tube just to drag people into the stores. This strategy inherently leverages and amplifies buyer power. It gives customers exactly what they demand, the lowest possible price.
By making low prices their defining thing, they empowered the customer like never before.
Totally. It forced competitors to either match them, which was hard, or find completely new ways to differentiate themselves.
And we see that continue today, don't we?
Oh, yeah. Look at more recent history. There's this idea of a race to zero in retail. These more-for-less big-box monsters created hundreds of billions in wealth. Sam Walton became the world's wealthiest man for a time.
And Amazon just took that playbook and put it on steroids.
Pretty much. Amazon's value proposition is crystal clear, compelling. A better life with, say, Heineken instead of Budweiser, Tide instead of Sun detergent, but at low prices.
So it's not just cheap stuff, it's better stuff, cheaper.
Exactly. That fundamentally increases buyer expectations and their power. Customers now expect premium quality, discounted, delivered to their door in hours. That constant drive for lower prices, better perceived value, all facilitated by Amazon's massive infrastructure, huge selection, Prime memberships, it demonstrates immense buyer power.
even while Amazon itself builds power in other areas like logistics and cloud.
Right. It's a complex ecosystem. Their fulfillment costs are huge, but they're sustained by membership fees and charging others to use their infrastructure. So buyer power is both a driver and a consequence of their whole strategy.
So if your customers hold a lot of power, you're just constantly pushed to innovate, differentiate, justify your price. It forces you to rethink your entire value proposition.
Constantly. What truly makes you valuable to them when they can just walk away or demand more for less? You can't just rely on habit or being slightly better. You have to continually earn their business, often under increasing pressure, by delivering undeniable value or creating really compelling reasons for them to stay.
Okay, so we've looked at buyers. Now, on the flip side, let's talk about the people who provide you with what you need to run your business.
Your suppliers.
Supplier power.
Just like customers can squeeze you, can your suppliers actually hold you over a barrel? Can they dictate terms, squeeze your margins from the other end, or even threaten your operations by limiting crucial stuff you need?
Absolutely, they can. The bargaining power of suppliers refers to their ability to raise prices, maybe reduce the quality of the goods or services they provide you, or even limit their availability.
Which directly impacts your costs, your cost structure, your production capabilities, and yeah, ultimately your bottom line. When suppliers are powerful, they can extract more value from the industry, diminishing the profitability of the firms within it, like yours. It's this constant tug of war for value all along the supply chain.
Okay, so what makes suppliers powerful? When do they have the upper hand?
Similar factors to buyer power, just flipped. First, concentrated suppliers. If there are only a few suppliers for a critical input that your business absolutely needs, those few suppliers have significant leverage.
You don't have many alternatives.
Exactly. Gives them substantial control over pricing and terms. Think about, say, the aerospace industry. Suppliers for specific, highly engineered, certified components are scarce. Huge regulations, massive investment needed.
Right.
So airlines or aircraft manufacturers often have little choice but to negotiate with just a small handful of powerful suppliers.
Okay, makes sense. What else?
Second, if the supplier's product is unique or differentiated, or if there are high switching costs for you, the buyer, to move to another supplier.
So if they offer something you can't easily get elsewhere.
Right, or it's just too costly, too risky, too disruptive for you to change. Think about specialized software providers whose systems are deeply integrated into your company's operations.
Oh yeah, migrating off something like that can be a nightmare.
Astronomical costs sometimes.
Yeah.
It locks you in. So if you've built your whole production around a specific component from one supplier or a highly specialized service provider, yeah, you're pretty much at their mercy for pricing and reliability.
Yeah.
That's a significant vulnerability.
Definitely.
Third, there's the supplier's threat of forward integration.
So they could become your competitor.
Exactly. If suppliers can credibly threaten to enter your industry themselves, they gain immense power. It forces you to maintain a good relationship, agree to their terms. Otherwise, they might just decide to cut you out of the value chain entirely and capture a bigger slice of the pie for themselves.
Wow, okay. That's a powerful threat.
It is. And finally, the importance of the input. Just how critical is the supplier's product to your business? If it's a core component you absolutely cannot function without, or a crucial raw material with no viable substitute, well, then the supplier's power is naturally amplified.
Without that input, your business just stops.
Grinds to a halt. Gives the supplier a very, very strong negotiating position.
What's fascinating here is how these power dynamics can shift in really unexpected ways. You mentioned Enron earlier. Thinking about their gas deals, they essentially became a super powerful supplier in a way that wasn't immediately obvious, right?
Yeah, that's a great, though notorious example. Enron, primarily an energy trading company, they kind of took on the traditional role of the banker in the natural gas industry.
Oh, so?
Well, at a time when banks weren't really lending much to gas producers, Enron stepped in. They offered cold, hard cash to these producers in exchange for long-term gas contracts. The producers desperately needed capital to drill new wells.
So Enron provided the money.
Right. But what made Enron particularly powerful was how they structured the deals. They made sure they still had the right to the gas, even if the producer went under.
Wow. Okay.
So this shows a company gaining huge power, not just by supplying a commodity, but by providing critical capital and guaranteed sales to its suppliers, the gas producers. It effectively turned those producers into dependent parties.
They were locked in.
Totally dependent. Enron could then leverage that power to dictate terms, secure gas at favorable prices, effectively control a huge chunk of the supply chain. The producers became, in essence, highly dependent suppliers to Enron's trading business.
That's a fascinating twist on supplier power. Any more recent examples?
Well, another interesting one, maybe not framed as a traditional supplier, is Amazon lending.
Amazon lending money to sellers on its platform.
Exactly. They provide loans to select merchants on their platform, ostensibly to help them finance inventory. Now, while it seems helpful, well, it enables Amazon to influence its own marketplace, increase sales on its platform. By becoming a financer, Amazon leverages its position to dictate terms that benefit its core retail business. It's a subtle but very real form of latent supplier power over its sellers.
Because the sellers become reliant on Amazon not just for customers, but for capital, too.
Precisely. It further entrenches Amazon's position in their business ecosystem.
So the takeaway here is, you really need to understand who holds the leverage in your supply chain. Are you beholden to a few powerful players who can squeeze your margins?
Or do you have options, maybe through diversification, developing alternative inputs, maybe even some in-house capabilities?
Yeah.
You need enough options to maintain a strong bargaining position.
It's about not letting yourself become overly dependent, constantly assessing where you're vulnerable.
Exactly. You need that visibility into your dependencies.
Okay, this next force. This one often catches companies completely off guard, not because it's hidden exactly, but because it looks so different from traditional competition.
The substitutes?
Yeah, it's not just about your direct rivals offering a similar product. It's about entirely different solutions that meet the same underlying customer need, often in ways you just never anticipated. This is where whole industries can get blindsided, isn't it?
Absolutely blindsided. The threat of substitute products or services refers to products or services from outside your defined industry that offer a similar or maybe even superior value proposition to customers. They solve the same problem, but through a totally different means.
So they're not direct rivals in the usual sense.
No. They're alternative ways for customers to achieve the same underlying goal. And crucially, substitutes place this formidable ceiling on the prices your industry can profitably charge.
How so?
Because if your prices get too high or your performance isn't good enough, customers will just switch to the substitute. It's not about Coke versus Pepsi anymore. It's about soft drinks versus water or juice or maybe even a different kind of caffeine fix altogether.
Okay, so what makes a substitute a real threat?
3 main factors increase the threat. First, an attractive price-performance trade-off.
A better deal, basically.
Yeah. If the substitute offers a significantly lower cost for similar performance, or maybe much better performance for a comparable cost, it becomes extremely appealing. Think about how many traditional industries, landline phones, physical encyclopedias, got disrupted by digital alternative.
Yeah, the internet, mobile phones.
They offered convenience, speed, often vastly lower cost or higher functionality. They weren't just new ways to talk or look things up. They were fundamentally better, cheaper substitutes for older methods.
So it's not just about price, but about the overall value customers perceive. A cheaper option might not be a threat if it's clearly inferior.
Right.
But a cheaper and better option, or one that offers some totally new kind of convenience, that's an absolute game changer, demands immediate attention.
Exactly. Second factor, low switching costs.
Again, how easy is it for customers to make the change?
Precisely. If adopting the new solution requires minimal effort, no big investment from the customer, no disruptive change to their habits, they're much more likely to abandon your product or service for the substitute.
But if there are high switching costs, maybe specialized training, new infrastructure needed, a big lifestyle change, that creates a buffer for the existing players.
Right. It slows down the adoption of the substitute. And third, related to that, is perceived value. How readily and willingly do customers actually adopt the new solution?
So it's partly psychological.
Very much so. It's not just about objective features. It's about the customer's willingness to embrace the new way of doing things. Sometimes a substitute can be objectively superior, but cultural inertia, maybe lack of awareness, skepticism can delay its adoption.
But once that perception shifts...
Adoption can be incredibly swift and devastating for the incumbents.
Okay, this is where it gets really interesting. Let's revisit Netflix again. Their streaming service wasn't just a new delivery method for movies, was it? It was a fundamental substitute for Blockbuster's entire core business.
Oh, absolutely. It completely changed consumer behavior and rendered Blockbuster's model obsolete.
How did that play out as a substitute threat?
Well, as we touched on, digital streaming was guaranteed eventually to supplant physical DVDs.
Yeah.
It was a classic case of a substitute technology disrupting an incumbent. Blockbuster was focused on competing within the physical rental space, better stores, bigger libraries.
Right. They were improving their existing model.
While Netflix recognized the broader customer need, entertainment delivery, regardless of format, they saw that streaming, even when it was small and glitchy, offered a fundamentally better long-term value proposition. Instant access, vast libraries, no late fees, all from your couch.
That's a powerful substitute value proposition.
Immense. And look at Microsoft, too. Satya Nadella recalled working on a video-on-demand service back in 1994 that became obsolete virtually overnight with the birth of the Internet.
The Internet itself was the substitute.
Exactly. A radical substitute for many planned technologies and business models. It offered a new, far more powerful, more versatile way to meet tons of information, communication, entertainment needs. It wasn't a direct competitor to that specific VOD service. It just rendered it irrelevant by offering a superior, more flexible alternative.
Wow.
And this whole idea ties perfectly into Theodore Levitt's classic concept of marketing myopia.
Defining your business too narrowly.
Precisely. He warned industries against getting complacent by defining themselves too narrowly. Railroads declined not because transportation needs vanish, but because they saw themselves in the railroad business, not the transportation business.
They missed the rise of cars, trucks, planes.
Exactly. Levitt warned the petroleum industry, for example, that their idea of indispensability could lead to trouble from outsiders, substitutes emerging from hungry investors and entrepreneurs. If you define yourself as selling oil instead of providing energy or mobility solutions.
You miss the rise of electric vehicles or renewables or something totally unexpected.
Right. That narrow focus on your existing product or industry structure can blind you to entirely different ways customers can solve the same problem. And that narrow definition can be a death sentence.
So it's really not enough to just watch your direct rivals. You need to keep an eye on seemingly unrelated innovations, even from way outside your industry, that could suddenly make your product irrelevant.
You need a much broader, almost philosophical view of your customers' underlying needs, not just clinging to your current solution.
Constantly asking, how else could customers achieve what my product does for them, maybe in a way I can't even imagine yet?
That's the vigilance required.
Okay, finally, let's talk about the competition directly within your own industry. Once you're in a specific market, selling a specific thing, how fierce is that fight? The battle for market share, for customers, for profitability, among the players already there. This is often the most visible force, isn't it? The one we see every day.
Yeah, this is the one most people think of first when they hear competition. Rivalry among existing competitors refers to the intensity of that competition within an established industry.
And when it's high.
High rivalry limits profitability for everyone. Companies compete aggressively on price, on product features, service, advertising, you name it.
It drives prices down.
Drives prices down, increases costs as companies spend more to differentiate themselves. And ultimately, it squeezes margins for everybody. It makes it really difficult for any firm to earn consistently above average returns. It can quickly become a zero-sum game, or worse.
A race to the bottom.
Exactly. A destructive race to the bottom sometimes.
So what cranks up the intensity of this rivalry? What makes it really fierce?
Several factors significantly heighten it. First, many competitors of similar size and power.
So no single dominant player.
Right. When there isn't one clear leader, and you have many firms roughly equal in size, resources, market share, it prevents any one firm from dictating terms or setting prices. That often leads to more aggressive tit-for-tat behavior. Everyone's jockeying for position.
Okay, what else?
Second, slow industry growth. Porter noted that when growth levels off in an industry, there's often this period of turmoil as intensified rivalry weeds out the weaker firms.
Because everyone's fighting harder for a piece of a limited pie.
Exactly. If the market isn't growing, any gain for one company is a direct loss for another. That makes the fight much more intense than in a rapidly expanding market where everyone can kind of grow together.
So if there's not enough new business to go around, companies turn on each other, engage in these fierce, sometimes self-destructive battles.
It really becomes a zero-sum game, or like you said, sometimes even a negative-sum game for the industry as a whole, if everyone's destroying value through price wars.
Okay, that's next.
Third, a lack of differentiation. Or, relatedly, low switching costs for customers to stay with an existing product. If products seem like commodities,
Space wars again?
inevitable. If customers can't tell the difference between your offering and a competitor's, or if the perceived value is identical, they'll just choose the cheapest. That erodes brand loyalty, transforms the market into a battleground purely for price.
Okay, that sounds brutal.
It can be. Fourth, high fixed costs or maybe perishable products. These create immense pressure to operate at full capacity and move inventory fast.
Like airlines.
Perfect example. Airlines have incredibly high fixed costs, planes, maintenance, routes, and an empty seat on a flight. That's a highly perishable product. Once the plane takes off, that revenue is lost forever.
So they slash prices to fill seats.
Often, yes, which can trigger competitive price cutting across the whole industry, even if it means flying at razor-thin margins, or even losses sometimes. Same applies to hotel rooms, fresh produce, fashion items at the end of a season, anything where you have to sell it now or lose it.
That pressure forces aggressive moves.
Definitely. And finally, a really critical one, high exit barriers.
Barriers that make it hard for companies to leave the industry.
Exactly. Porter described how exit barriers keep companies operating in an industry even though they are earning subnormal returns on investment. They're trapped.
What kind of barriers? Not just money.
No, not just financial costs, though that's part of it. It could be specialized assets you can't easily sell or repurpose, like a factory built for one specific thing. It could be labor agreements that make layoffs super expensive. Could be emotional attachments, especially for founders or family businesses. Even government restrictions sometimes.
So companies are forced to stay and fight, even if the market is declining or unprofitable.
Right. They keep fighting fiercely for whatever scraps are left. It prolongs the agony for all the players and prevents the market consolidation, the natural weeding out of inefficient firms that might otherwise eventually lead to higher profitability for the survivors.
It's a cruel paradox.
Yeah.
The harder it is to leave, the more intense the fight becomes for those who remain.
That sums it up perfectly.
Okay, let's unpack this with another example. Back to Walmart again. When they started, Sam Walton himself said the discount industry was full of high living, big spending promoters, but very few good operators. Then, boom, 1962, the same year Walmart opens, Kmart, Woolco, and Target all launch discount chains.
Yeah. Talk about jumping into a crowded pool.
That's not just competition. That's a highly competitive, instantly crowded environment right from day one. Talk about intense rivalry.
Oh, absolutely. The early discount industry was a real crucible of intense rivalry. And Walmart succeeded, not by avoiding that fight, but by relentlessly focusing on low prices and satisfaction guaranteed, constantly improving customer relationships, and crucially, as Walton emphasized, taking exceptional care of its own people.
He believed that was key.
He really did. He thought that allowed them to outlast many early discounters who he said disappeared because they weren't taking care of their customers, not minding their stores, not having folks in their stores with good attitudes. And he tied that directly back to how they treated their own employees.
So in a market with intense rivalry, where maybe everyone looked similar at first, operational excellence, culture, customer focus became the differentiators.
They became the critical differentiating factors that allowed Walmart to thrive while others failed. It wasn't about avoiding the fight. It was about fighting smarter, building a sustainable advantage through superior execution day in, day out.
Right. And this intensity, this kind of fight in established markets, this is what people call red oceans, right?
Exactly. These red oceans are existing market spaces where companies just try to outperform rivals, grab a bigger share of existing demand, often through those price wars, adding features, battling head-to-head. It gets bloody, hence red.
And the alternative is blue ocean strategy.
Right. That strategy aims to escape the red ocean. As described in concepts like blue ocean strategy or discussions around red ocean traps, the goal is to create new market spaces, blue oceans, where competition is largely irrelevant or at least significantly reduced because you've created uncontested demand.
How do companies do that?
Well, think of companies like Cirque du Soleil. They didn't try to be a better traditional circus. They blended circus arts with theater, creating something totally new, appealing to adults, not just families with kids. Or Starbucks, taking coffee way beyond a commodity diner brew, Dyson with vacuum cleaners.
They didn't just compete on price within the existing industry.
No. They pursued both differentiation and often lower costs in certain areas, effectively pricing against the substitutes and alternatives that non-customers were currently using, not just pricing against direct industry rivals. They redefined the problem and the solution.
So they sidestepped the head-to-head battles, created new value for customers who maybe weren't even in the traditional market before.
Exactly. That's the essence of creating a blue ocean.
So if you find yourself stuck in a red ocean with just brutal rivalry, constantly battling on price or features, the strategic move might not be to just fight harder within those old boundaries.
Right. It might be to try and redefine the market itself. Create a blue ocean where you can set your own terms, innovate on value in a different way, capture totally new demand instead of just competing on everyone else's terms.
It's about creating new value, not just capturing existing value more aggressively.
A fundamental shift in perspectives.
Okay, so we've now walked through all 5 of these powerful forces. The threat of new entrants, the immense bargaining power of buyers, the often underestimated leverage of suppliers, the menace of substitutes coming from unexpected places, and that intense rivalry among existing competitors. This really isn't just an academic checklist, is it? It feels much more like a living, breathing framework for thinking strategically.
Cool. Not at all academic in practice. Understanding these forces is absolutely crucial for a company's strategic planning, its long-term viability, frankly, its survival.
Why so critical?
Because it highlights your critical strengths and weaknesses. It animates how you position yourself in the industry. It clarifies where strategic changes might actually yield the biggest payoff. And it helps you identify those significant opportunities or threats emerging from industry trends.
Things you might otherwise miss if you're just focused internally or only on direct rivals.
Exactly. A deep, nuanced understanding of these forces helps a company find a truly profitable and defensible position. And most importantly, develop a more robust, more resilient strategy for the long haul. Without this kind of systematic analysis, strategies often get built on incomplete or just misguided assumptions.
Leading to wasted resources and, well, often failure.
Sadly, yes. This framework helps calibrate that intensity of power, as Hamilton Helmer puts it. It helps answer what really governs profitability for a company. By systematically analyzing these 5 forces, you can spot which ones are maybe weakest in your industry, presenting opportunities you can exploit.
Like maybe lowering entry barriers for a new product line you control, or finding new ways to differentiate to reduce buyer power.
Exactly. Or conversely, it identifies which forces are strongest and demand immediate attention to build defenses against them. But it's not just a static snapshot, right? These forces are constantly shifting, interacting.
Yeah, they don't exist in a vacuum.
No. A truly robust strategy involves anticipating those shifts, understanding the interplay between forces like how low entry barriers might intensify rivalry down the line, or how a powerful supplier might actually enable new substitutes to emerge, and then prioritizing your strategic moves based on their likely impact on your long-term profitability.
And it's not just about reacting to the forces as they are, is it? This framework feels like it empowers companies to proactively shape the competitive environment.
That's the higher level goal, yes.
Right.
It's about influencing these forces in your favor, rather than just being a passive cork tossed around on the waves of competition. That's where true sustainable strategic advantage is built.
How do you actually do that? Influence the forces?
Well, by understanding the underlying drivers, you can implement deliberate strategies. You might try to raise entry barriers for potential rivals, maybe through patents, or building brand loyalty or achieving scale. You could differentiate your product relentlessly to reduce buyer power. Cultivate strong, maybe even collaborative supplier relationships to mitigate their power. Mitigate the threat of substitutes through constant innovation or building an ecosystem around your product. Or find ways to reduce the intensity of direct rivalry, perhaps, by creating new market segments like in blue ocean thinking, or maybe through strategic alliances.
So it transforms you from being reactive to being proactive, a shaper, not just someone being shaped.
Precisely. It allows companies to try and sculpt their competitive destiny, rather than just being sculpted by it. It's about agency within the structure.
Outro.
Oh, okay. Today, we've taken our first really extensive deep dive into Michael Porter's competitive strategy, meticulously exploring these 5 forces that fundamentally shape pretty much any industry you can think of.
We covered a lot of ground. We really did. We've seen how that constant threat of new entrants can dilute profits, how the immense bargaining power of buyers and suppliers can squeeze your margins from both ends, how that insidious menace of substitutes can redefine entire markets, sometimes seemingly overnight, and how the relentless intensity of rivalry among existing competitors forces companies to fight tooth and nail for every bit of market share, often at enormous cost.
What a powerful dynamic.
Incredibly powerful. And this analytical rigor, it isn't just theory, is it? It's an indispensable tool for anyone trying to navigate the complex, constantly shifting landscape of business. It moves you way beyond just observing competition to truly understanding its underlying dynamics.
He gives you that roadmap.
Yeah, a roadmap for finding and, more importantly, maintaining a defensible and profitable position. This isn't about guesswork. It's about informed strategic action that can genuinely make or break a company.
And remember, this is just the beginning of our multi-part series on competitive strategy. Next time, we'll delve even deeper. We'll look at how companies can actually apply these insights to carve out unique positions, build lasting advantage, moving beyond just the analysis to really actionable, implementable strategy.
Getting into the how-to.
Exactly. Because what's truly fascinating here, as Porter himself asserts, is that the long-run profit potential depends on future structure. And understanding these forces is the absolutely essential first step in proactively shaping that future, anticipating change rather than just constantly reacting to it.
Okay, so as you, the listener, reflect on these forces, maybe consider this provocative thought. In a world of constant technological upheaval, where these black swan events, those rare, high-impact, unpredictable occurrences, can swiftly reshape entire industries, how can a company not only defend against these five forces, but also anticipate, adapt to, and maybe even leverage them to create entirely new markets and redefine competition itself?
That's a deep question.
It is. And how might something like the age of disenchantment for stock investors back in the 2000s, where price earnings multiples just plummeted, how might that connect to entire industries maybe failing to adapt their strategies effectively to these powerful, evolving, competitive forces?
It's a stark reminder, isn't it?
It really is a reminder that even the most established players, the seemingly unassailable giants, can absolutely be undone if they don't continually reassess, adapt, and proactively engage with these powerful shifting dynamics that underpin all market competition. Complacency is death.
Well said. Looking forward to diving deeper next time.
Me too.